Saving for a deposit in Sydney now takes the average person 40 years, which is long time. Because by
Yeah.
the time you save that deposit, do you think 40 years time the price will be the same? No, they'll be different. So it's sort of like a running train. Most of you are not going to get there because the market's going to grow faster than your savings unless you make a shit ton of money. So therefore, you need to find the way to get in before you miss out. That's the fact of it.
Who got a $7,000 return, like investment return, for 12 months on his whole superannuation, and he had a $14,000 in fees. So he's
Wow. They
effectively
lost money.
backwards,
He went backward.
going backwards when he compares the two. But the conversation is only ever really on the returns.
When it comes to asset protection, no one can take your super money. Simple. If you got four in super, you could almost do one each anyway. That's the thing. So what we're doing is helping people that can't get it themselves. I would much rather someone get their own property than Super 6 because it's going to be more powerful for you. However, if you can't get one in yourself or you got extra cash, join with someone else and get the extra one anyway. Because the name of the game is you want to get as many properties as you can early on, and then you do nothing and wait and let them grow. Okay, hello, this is George Markoski coming to you live with Jeff Bennett for our weekly Money for Life. Jeff, welcome.
Thank you so much. It's always great to be in the environment of very enthusiastic, positive property members.
Yeah, now look, 2020, this is the last boom of 2020 here in 2025. This is it. So if you missed this boom, you've missed the last one of the decade. And a lot of people are having challenges because let's face it, property prices have gone up and it's not that easy. Saving for a deposit in Sydney now takes the average person 40 years, which is long time. Because by the time you save that deposit, do you think 40 years time the price will be the same? No, they'll be different. So it's sort of like a running train. The way I see it is the property market's a bit like this. If you look at the property market, it's like a train and it's going along, and you can, while you're saving the deposit or getting ready to buy, you're actually going along to the train, but the train's slowly getting more momentum. Then slowly you've got to start jogging to keep up the train. Then you've got to start running. And now in 2025, you've got to be really fast. And the problem is pretty soon the train's going to go so fast, you can't catch that train and you've missed it forever, because that train is your destination to get to financial freedom. And some people are never going to get on that train. And the next 10 to 20 years, home ownership is going to go down every year in Australia, and less people own a home. The Aussie dream of owning a home is disappearing, unfortunately. And there's going to be two types of people. People that just got into the market, did whatever it takes right now. And then there's going to be people that missed it. And you know what? One day, when your kids or grandkids are sitting on your lap and they're going to go, that last big boom of 2025, why didn't you buy more property, Granddad? Why aren't you rich like my friends at school, right? Or grandma. So you really want to be on the right side of history on this. And that's important. So the thing is, in order to get a property in super, how much do you normally need?
To get a property in super?
Yep.
Look, it's a difficult question to answer because it depends very much on the property that you acquire. It depends very much on how much your contributions are. But we wouldn't say be looking at beginning that journey if you've got less than 200,000. Definitely, you'd need to be on the other side of that and upward.
Yeah. So in order to get a house right now, a good investment property, because a good investment property is going to cost you between somewhere around 450 if you really find an amazing bargain, or 750. That's the price range for properties that are going to go up quite a bit. So in order to get that, you're going to need either 100,000 equity, 100,000 deposit, or 200,000 super. That's what you're going to need, and you're going to need income as well to support that. So there's some people that just don't have 100,000 deposit. They don't have $100,000 cash in their bank account sitting around doing nothing, unfortunately. And they don't actually have 100,000 equity in their property because they're renting or they just bought their property or something like that. And they don't have 200,000 in their super because they haven't been working long enough to do that. So
Mm.
there's a gap in the marketplace of people that just can't get property at the moment. And the sad part is, this train is moving, it keeps going, and they're not going to be able to catch it. Now, Jeff, you and your team have been working behind the scenes very diligently to try to address this issue.
Mm.
And the beautiful thing, what we're going to talk about tonight, what we're going to show people tonight is you actually don't need 200,000 super to invest in property anymore, because you see that train that's going, and we want the first class seats on this train, right? We don't want to go in the baggage department and fall out of the train and die, because when you look at property investors, 2/3 of property investors lose money. So you don't want to be in the back seats. You want to get the top 100 properties in the front carriage, the first class. But to get into first class, you need 100,000 deposit or 100,000 equity and 200,000 super. So let's say you don't have enough money for a first class ticket. What do? You can try to sneak on the train, but it's not going to work. But there's one thing you can do. What you can do now is we've got these special seats at the back of this first class carriage, where you can actually share a seat, and 6 people can come in together and get a seat on this property train and create financial freedom and not miss out on the latest boom. That's in essence what we're talking about, isn't it?
It is. It's exactly what we're talking about. I really like the analogy of the train, because linked in with your comments in your opening, George, the fact is that it is moving faster and faster away. I'll have people who'll come and see us at Super Strategist and say, look, we want to set up a self-managed super fund. And after we have a chat to them, they might say, look, what I might do, I've got like $190,000. I might just wait and really work my ass off saving in order to get a much bigger balance. After they come back in a couple of years, you think, some of the product that I've seen move in property in the outskirts of Brisbane 4 years ago might have had a 4 in front of it. Now it's got a 6. High 6 in front of it. And so those people have gone away to work on achieving their financial objectives in superannuation or their personal life, just in saving doesn't necessarily achieve the objective. And I think that goes to the heart of what George's opening comments were about, that moving away from a lot of people in what used to be referred to as the Australian dream. So wrapping all of that up, we're saying, well, superannuation and self-managed superannuation has an edict that it has an ability to connect 6 members together. Now, families are already doing this. Families are getting mum and dad and 4 of their kids together and forming a self-managed superannuation fund. The limitation is that it's up to a member of 6, and we're saying, well, if we've got 6 people who, on the one hand, are really in love with this strategy of property because their grandparents loved it and their parents loved it and it worked for them both, but they really love it. But there are just so many barriers to entry in order to achieve that Australian dream. Why don't we go back to the drawing board and see if we can come up with some options for people? There is an insatiable appetite for property. I mean, everyone wants it, but there is only a very narrow gate from which people are actually entering the market, and it's after they satisfy all those barriers to entry. It's probably timely to raise the fact that there is existing government policy that's underway and being released right now, which is only, all of the commentary says that it's only exacerbating this issue, because we have this 5% government guarantee, which is flooding a market for that first home buyer sort of entry, where people have worked their bum off to save for their deposits. Now they're actually having to have those auction fights with people who are being guaranteed by the government. What does that mean? It means that there's a flooding of the market. What does it do? Supply and demand curves don't negotiate.
No,
They are a fixed economic fundamental. The supply and demand curves don't negotiate. Where there are more buyers, the property of the product
Jeff,
must rise.
the problem with the government, right? They haven't done a basic economic class. That's the problem, because it's very basic. There's only 2 things that matter: Supply and demand. Nothing else matters at all. And really, at the end of the day, the only way to help more people own or live in more homes is to increase the supply.
Mm.
Whenever you try to increase the demand, which is what they've done, you're not helping anyone, because all you've done is increase the demand. You haven't fixed the supply problem. You've just created the Hunger Games of property and everyone fighting over it and creating more
Yep.
demand, which makes the property price even higher, makes it even harder, right?
Mm.
Right. So,
Yeah, that's absolutely right. Well, it really dovetails into your projections that said, well, there is going to be a boom in the market. And if that is your perspective and you've been doing it for a very long time, George, and I think when you talk, I think people need to listen. If there's going to be a boom in the market, certainly those factors seem to be pointing to that sort of upsurge. Now, what does that mean? Well, it means that we need to find ways that we can potentially access the market, which are a little bit more innovative, still give you direct ownership, still give you direct control through your super.
yeah, well, what I'm about to say now, before we get into this, is going to piss a lot of people off. But those are the exact people that need to hear this. The fact that it is, if you can't buy property at the moment and you think that you can save your way there, most of you are not going to get there because the market's going to grow faster than your savings unless you make a shit ton of money. So therefore, you need to find the way to get in before you miss out. That's the fact of it.
Mm.
So, and that's the fact of it. And so what I'd love to do now is let's talk about super, and let's talk about how people get property in super, and then
Yep.
move on to what you've done and what you've created.
Yep. Okay. So first point I'd like to make is that people think about super. We are taught a particular way by the large financial institutions in this country that as soon as someone says superannuation, that everyone just goes eyes glazed over and says and tunes out. But ultimately, it's your money. The thing I get really passionate about is just to say to people, look, if you're not buying personal investment properties, if you're not buying a principal place of residence, you need to look everywhere you can in order to try and accelerate your wealth creation strategy. And so what we've done is we've looked at superannuation to address this specific issue. We call it 6 in Super. It's a trademarked name. Do you mind if I just share my screen,
Please go for
George?
it. Yep.
Okay, I'll just see if that works. You should be able to see that. Essentially framing this up, this is information only. I don't want you to take this particular meeting or the details that I'm sharing this particular meeting in any way as personal advice. I'm not sure who you guys are individually or what your personal goals are, but this is just factual information. We talk about some hypothetical scenarios as well, and that's just exactly what they are. So it's all about 6 in Super. And it's taking a portion of, well, it can be a portion of your superannuation, or it can be whatever balance you currently have, and having it under a regulated self-managed superannuation fund. So essentially, the direction is that we give you direct property ownership. So there is a fund which will have the ownership over the property. You'll be a director of that fund, meaning that you will be a director of a corporate trustee, which will administer the fund. There are some really strong opportunities in that. And then there are some things that we need to consider in that also. The real power in this. The power is not just to say, oh, I've got a portion of an investment property. The real power in this is how it can accelerate over a period of time. We've got more people pooled into a specific strategy in order to achieve the outcome. And sometimes it's the power of buying that can generate. You might have heard the expression before that money makes money. You also get people say, oh, geez, isn't that person lucky, when really they've been working their ass off all of their life, or even maybe not working their ass off all their life, but just making some key decisions at the right time.
Jeff,
So we pool the buying power. Yep.
it's a bit like how I became an overnight success after 20 years of hard work.
Yeah, that's right. So we talk to people about the fact that they don't need to do massively different things in order to create intergenerational wealth. But it's about if you feel that it's the right thing to do, well, to make those decisions at the right point in time. And we come across, many people and talk to them about their wealth over the course of any one year. And we get these people who are ready, aim, ready, aim, ready, aim, ready, aim. We also get the other side of that as well, which is not great either, which is ready, fire, ready, fire, ready, fire. All we ask you to do is to employ a strategist. Ready, let's have a look at it. Let's aim up to it. If we think it's right, let's push the button on it. So there's lots of different types of people, and we encourage people to, not overthink these things. Just get themselves to a level of satisfaction where they're prepared to do the little things that are different to the way that they've always done them. What this strategy does is it enables you to bring forward, if you were in love with property and you want to get a hold of property, this brings forward that timeline, as I mentioned a little bit earlier. The market's moving away from you. How do you get exposure to it? And there is the age-old adage of the derived income source, acquired income source, while ever you hold that property. So that's the vision that we have.
But also, can I add one thing? This
Please,
has been
please.
designed. What I love about this design is you've designed this so well that it's positive cash flow from day one.
Yes.
Right?
Yes.
So you're investing in property, which is going to grow, and not only that, it's positive from day one and keeps expanding. So you've got a ticket on that A grade train quicker, so you can build your portfolio faster, which is exciting.
Yeah, and not only is it exciting, but I was blown away today when I was running some financial models on how quickly it can develop into something very, very big. So the other thing is a lot of people are prevented from getting into a self-managed superannuation fund because there are some debilitating costs. It's a very big hurdle in order to get into a self-managed super fund, because normally it's mum and dad or dad who are shouldering all of the costs of a self-managed super fund. And that's why it attracts the attention of people like ASIC and the ATO. They've all got a vested interest in you doing well out of a self-managed superannuation fund. So what they do is they provide guidelines around the fact that the fund needs to have enough financial resources to be able to sustain the fund, meet its bills as and when they fall due, all of those things that they have a concern for you about. So the benefit of this is by virtue of the fact that you've got 6 people in a fund, well, you're only paying 1/6 of the expenses. And so they become diminished somewhat with that pooled buying. And then, of course, faster compounding elements. So if we're getting larger amounts of cash and then we're getting some interest in those, I've only used in the scenario I've painted up here today some very, very dour cash component interest rates. But let's just get into the cost. This is often one of the things that people desperately want to know. And part of the beauty of this design is the fact that it's targeted at mum and dad style investors. Typical fees in a superannuation fund, can be around that $1,500 to $2,000 a year. I get people who come into the office here all day, every day. I saw a guy who got a $7,000 return, like investment return, for 12 months on his whole superannuation, and he had a $14,000 in fees. So he's effectively going backwards.
He went backwards.
Going backwards when he compares the two. But the conversation is only ever really on the return. So things to be aware of, that there's a lot of differences in terms of what fees are. Some companies, some organizations like industry funds, they'll say to you, well, compare the pair, our fees are significantly lower. So yes, while that might be the case, it sometimes costs a lot more to keep those industry funds going, because they might not be being run as efficiently and effectively as some of the more privately owned retail funds. So just some things to consider there in the cost. The model for 6 in Super is we are charging the initial setup fees to each individual member. None of these fees are paid for by the members personally. It has to be charged to the actual superannuation fund. So what we would do is we would roll everything over into a self-managed superannuation fund and then make the deductions from your superannuation from that particular fund. There's high levels of regulation in self-managed super. The ATO is going to want to have a particular interest in a self-managed super fund. Every single self-managed super fund needs to be audited every single year. We need to pay for those audits, but there's also a high degree of accounting and compliance that needs to go on. Each of the individual members, they need to have their individual balances accounted for separately. So just to show you the setup fees, so we need to set up the structures. We need to apply for some trusts and some companies through ASIC. That's $1,495 per member. Ongoing costs, it's about $120 a year. So once you've got everything set up and you're going, it's about $1,500 a year. And there's the annual audit, which is $249 per member. Normally speaking, if mum and dad were to go into a self-managed superannuation fund, they're going to be paying a whole lot of money to set these things up. But because we're able to split it up amongst the members, we're able to make it reasonably comparable to an actual retail fund.
Okay, great. That's excellent.
Yeah, and so let's get into some of the good stuff. I've done up a hypothetical scenario here. This is a scenario, George, where there's actually no borrowings. And we talked about how exciting this could look. I've used 120K.
Yep.
Each member has 120K. Now, this is a person who is still 5-6 years away from even beginning to have a conversation about property. But with the power of 6 in super, I'm just going to run you through some scenarios that I came out with, and I want people to fact check them, and I'll tell you about my methodology. You guys
So
are...
I can fact, Jeff, I know about property. I can fact check them right here, right now. Don't worry.
Yep, perfect. So what 120 grand by 6 gives us is a balance start of 720K. That's net proceeds. We're going to make an initial property purchase of 600,000. I've taken into account, the some stamp duty. I've taken into account some conveyancing. I've taken into account the fees down here as well. I've selected a modest salary of, say, $68,000. And then said, okay, well, what if the superannuation contributions from each of the members was $8,000? Now, what that does for us across this is actually give us almost 50 grand in cash coming from each of the members, propping up this fund. So we've gone and bought a property worth 600K. We're getting rent at 600 a week. Now, that's a gross number at 31,200. But there's a bit of a method in my madness. I'm going to use the full gross amount because I haven't deducted the tax benefits that occur when you get a self-managed super fund.
That's what I was going to say, because we'd also got $1,800 on tax benefits on top of that on a $600,000 house.
Yeah, that's right. So what I've done is I haven't included the tax benefits, but then I haven't actually taken into account the costs that are in this. And you might see it differently. Well, I'd encourage you to just push the numbers around how you would think it might work. But this is just putting up some numbers so we've got something that we can put our teeth into. The fees across all of the clients end up to be 10,000. I've deducted that from the fund. I've added what I believe to be in these circumstances a moderate growth.
Very conservative.
I think with subject matter experts like Positive Property behind you, I've been recently to their conference in Bali, and I've heard firsthand from real people about case studies where they're achieving much, much more than that. But for the purpose of this, let's make it modest, return at 6.2%. And I've said that the residual cash, I'm only going to give that 2%. Now, I think every day of the week I can make a phone call and get better than 2%. I can get probably 4% without any risk to the cash whatsoever in a cash accelerator account. So after 3 years on this hypothetical scenario, that just cash sitting at the bank is 310K. And what that would say to me is, hey, 6 directors of this self-managed super fund, what are your thoughts about potentially going and borrowing and re-triggering and going again? because you've still got the 50 grand coming in. You've got the house bought outright. We just get an LRBA, which is the superannuation loan, attached to the second property, and we start the whole scenario again. This is after 3 years, and then the property value on those numbers ends up at 718. So the superannuation fund on this hypothetical scenario, with I think some reasonable estimates, ends up being a tickle over $1 million on
Jeff,
the 3 years.
you've been very conservative, and I'd imagine over the next boom that's going to be much higher. But it's good that you're conservative, because worst case scenario, you've made this sort of money and you've got $1 million fund, which started off at 20, but I'd imagine it'd be a lot higher, because obviously what's happening in the property market, the supply and demand curve.
Yeah, that's right. Well, I would hope, even to further that point, Jules, I would hope that the contributions being made by each member are going to be increasing each year, because their salaries are going to increase. And these guys are really only on 65K, and the average Australian wage today is 100 grand. So if you're earning 100 grand, well, you know, in today's day, you're getting $12,000 put in there. So you can see that I've used some quite conservative metrics to be able to paint this particular picture. Now, people then say, well, hang on a minute. Well, I've put in 120K, but I've been working my bum off and putting in more contributions than other people. All of that's completely fine. Under the Superannuation Industry Supervision Act, we're obligated to account for each individual member's balances separately. So whilst it is one fund, it's not just, and one primary asset when it starts, which is the property, it's not everyone's got the same cut. It's every different member has a different valuation within their fund. So that's what.
So basically, what you're saying is you calculate how much people contribute, how much their money's gone up, how much their property's gone up. So you've got the exact percentage of what they own. So if one person starts contributing less, then their shares just go slowly down. If someone puts more in, their shares go up. So it's all calculated, so it's all fair. So you don't have to worry about other people, right?
You don't have to worry about that. That's what our job is. And further to that, the ATO is specifically interested in that. And that's why there's an audit every year, to make sure that we've done the right thing with everyone's account, and make sure that you and your obligation as directors are honouring those requirements in your capacity as a trustee or director of the corporate trustee. So they're the numbers. We've said, look, let's leave a level of comfort there. We've got 720,000. We're only buying a property that's worth 600,000. In all of those numbers, we've accounted for all of the elements that go into buying a property. Yes, I've used just the flat gross, but I haven't included the tax deductions to the fund either. And, you know, it's a reasonable summary of that hypothetical scenario.
Yeah, because we also got depreciation on the property, and therefore we're getting money back every year, depreciation as well.
Absolutely, absolutely right. That's what the fundamental is, the depreciation on the brand new property, on the fixtures and fittings, and also the dwelling itself. Look, there's some things that we need to look out for. We need for you guys to understand that, like any property investment, we go into them thinking that we're going to make money. And look, it's not like shares. It's not like cryptocurrency. We can't just trade this in a minute's time. These are considered strategies. You know, when people talk about bricks and mortar strategies, they're talking about the time that they spend in the market. They don't talk about timing the market. It's about actually staying in and getting that capital growth and that acquired income benefit over a sustained period of time. So we want you to think of these types of strategies as longer term investments. The challenge in this is that you guys are really helping each other. Each person who comes into this is being assisted by the other 5 members, and there needs to be that base level of respect for each of the other person who are on the train. You know, you want to get on the train, you want to have a nice journey, you want it to be pleasant. You don't want to be sitting there with someone who's throwing hot dogs around the cabin. We want to be able to work well with each other so that everyone can have a pleasant journey. And I think that that's worthwhile remembering. And to that effect, decisions around the investment property require some consensus among the directors of the corporate trustee. You guys will be required to make some decisions about it. Now, we can obviously facilitate those. We can have meetings with all of the directors and catch up on meetings like this where we can address some key decisions. But we need to be unified with regard to the fact that whilst we're on the train and it's achieving its objectives, then someone, this last point here, leaving the fund can trigger some changes within the fund. Now, on the hypothetical scenario that I've used, we'd always like you to be in a very strong cash position, such that if there was $350,000, like in the scenario I painted before, $310,000 in a very short 3 years' time, if someone wanted to leave, the fund could potentially pay them out of their cash assets. That's why it's always a good idea.
Shares goes up, correct?
Yeah, that's right. But look, the fail-safe is ultimately if the 6 directors can't work together, and we need to address these types of worst case scenarios. If we find a position where people say, look, we want to chuck our toys, well, we simply sell the assets. I mean, everyone just realizes the benefit that's occurred over that period of time. We sell down the assets and we go through a process of winding up the fund.
Yeah, so Jeff, I guess once the fund gets big enough for each person to get an individual property, selling the assets would make a good idea because then everyone can go off and get their own property instead of being stuck with everyone else. Would you agree?
Yes. Yes, absolutely. In fact, it is used. There is a consideration of capital gains tax if we sell the asset prior to reaching an age of retirement, we're up for capital gains tax. But look, in the grand scheme of things, I think that you can factor that in as a cost because ultimately we see six in super.
What's the capital gains on a superannuation property?
Well, because it's under a company structure, it's different to owning it personally. There's a whole range of different, I've heard of a 10% rule where they say of your profit, there's 10% of that. But I don't want to appear to be giving taxation advice on this particular. It would depend on individual circumstances, and we'd need to review that at the time. But look, there is a component that would need to be paid in tax. You're only paying that tax if you're making substantial amounts of money. And again, that cash component of capital gains tax would be divided amongst the 6 people. So
would it be different in a personal name? Because
I believe it is because
super, would it be treated differently? Because I think most things in super are 15%, aren't they?
They are, but let me take it offline and I'll come back to you because I'm just treading care because I don't want to give
I agree. We want to get it exactly right.
Yeah, exactly. I'll confirm it for you for next week. And maybe the best way to do that would be just to draw up a few scenarios and show you at what point the different capital gains tax implications are. That might be a good way of painting a picture for you.
Mm-hmm.
And the other key risk, of course, like every property investment that you make, is the sale price of the property can fluctuate. The net amount of rent that you get can fluctuate. So interest rates are another factor. They appear to be going down for the time being. I think George is predicting potentially another one in a drop in 2026.
Maybe another 26.
Yeah, okay. So it appears to be going down. A lot of commentators are agreeing about that, but it's a key risk that you can go into that it's going to be going up. Again, I've showed the power that can be achieved in these cash positions, and effectively you're accessing the market where someone, maybe a teacher, maybe a copper, is moving into this investment strategy and paying you for the right to live in your investment strategy every single week. Can't highlight more how surprised I was when I was interrogating some financial modeling about, I showed you how it moves over a period of 3 years. Once we then potentially go and look at a limited recourse borrowing arrangement, so a loan with that 300,000, if the directors wanted to go that particular way, then we've got 2 properties in. And it's almost like we're starting to drop a V8 engine in, because then we've got two renters putting in, as well as the almost $50,000 in contributions. Well, we would hope it would be over $50,000 in contributions each year, after a few pay rises from individuals who are contributing to the fund after a 3-year period. So remember, we're talking 3 years down the track. We've got over 50 grand coming in, hopefully in cash, on top of whatever rent that's being received. Very, very powerful. All of these things I've been through before. We enter the property market sooner. We amortize our costs across members. We've got the capital appreciation, which you've got in your retail superannuation fund at the moment, but we've also got the income which complements it. And we're really making some very powerful gains in our superannuation. We always like to talk about superannuation as an incredible part of your wealth journey. Yes, be doing everything in your personal life, but why not get every aspect of your life working as hard as it possibly can for you for your retirement. I need to say something, that this product is a proprietary product to us. We've registered the trademark on this 6in Super, and it was developed specifically for the members of Positive Property. No one else has access to this. We don't advertise this publicly. It's available through Positive Property members, and through Positive Property, we're happy to receive your contacts. And on that note, I always like to say a couple of things whenever I'm having a session with George, and that is, I get to see behind the scenes how hard Positive Property works for their members. There's a lot of things that a lot of the members don't see about what goes on in order to be able to deliver consistently the types of wealth that people are enjoying at the moment. And yeah, that's it from me.
Excellent, thank you. Now let's do some Q&A. Jeff, thank you. I really appreciate that. That's great, and
Yeah, no problem at all.
make it exclusive to us. You've worked really hard behind the scenes to get this happening, and I'm always trying to find ways for our members to accelerate their property journey, because it's a matter of getting our members to have as many properties as they can, because the more properties you've got exposed to the market, the more you make. So what we're going to do is we're going to do Q&A. Then after that, we're going to go in our private group and do our little breakout rooms and go a little bit deeper. For the people in public that are watching this, I've opened up 6 spots for this. So if you want to be one of those 6 people, type in #super, and my team will reach out and see if you qualify. But basically, you've got to look at your super account, and if you've got more than $80,000 in your super, then you do qualify. So the first 6 that call out, I'll get my team to reach out and give you the opportunity to do this. So let's go through these Q&A. I've got a question. If I use super to buy a house, do you have to pay tax on super you use to buy property?
Let me try and unpack that question. First of all, superannuation is its own ecosystem as far as taxation is concerned. So it comes with contributions tax. So every time there's contributions that are made within the fund, that's taxed at 15%. Then there are, in a self-managed superannuation fund, there are deductions that can be made. Probably the most simplest way that I find resonates with my clients, that in which I explain it, is where you have like a retail superannuation fund or an industry fund, your employer is paying in your full super contribution and then taking 15% of that out. Now that we're under a company structure, companies operate quite differently. So when I say company structure, it's a corporate trustee. But the way that works is they say, well, hang on a minute, we're a company now. We don't prepay our tax like every other PAYG person. We're going to hang on to all of the funds. And then at the end of the year, when we do the tax return for the company, what we're going to do is work out what we owe you, what you owe us, and we'll pay you the residual of that.
Difference.
So that's an important distinction between self-managed super and your normal PAYG employer contributions.
Okay. Are we talking about 200,000 for property in a super? What LVR are we talking about? What can you borrow?
If we're talking about, are you reading from the chat?
Yeah, I'm reading from the chat.
Yeah, okay. So with regard to 6 in super. What we're talking about.
This is not 6 in super.
Okay.
This is
Okay.
talking about 200,000 to buy.
Okay.
So basically,
we're talking minimum 200K for property and super. What LVR are we talking about? Okay, great question. So let me talk to that. It's really important that the LVR is really quite fixed. And the reason it's fixed is because the banks can only lend to a bare trust. Bare trust, the feature of a bare trust is what makes it unique. It needs to be bare of any other asset save for the one property that it owns. It can only ever own it. Now, the bank lending to the bare trust then has a financial relationship with the bare trust. And then if something goes unforeseenly wrong and the bank comes and wants its money back, who does it sue? The bare trust. What does the bare trust own? One asset. So for that reason, written into the superannuation legislation, it protects your superannuation from who? From the banks. Why? Because at the beginning of that financial relationship, at the beginning, the bank isn't going to lend to the bare trust any more than it absolutely knows that it's going to get back on its worst day.
because
That's
it won't be able to get any money out of the bare trust. Impossible. Because the one thing, when it comes to asset protection, no one can take your super money. Simple. Is that right?
Well, it's right in the relationship of the LVR. It's written in the law that states that the bank cannot go after your cash management account or your other superannuation assets. It is limited. Listen to what the name of the loan is: a limited recourse borrowing arrangement. And what that means is the banks are limited in their recourse for that borrowing arrangement, and they're limited. What that means is they can't sue your other superannuation assets if they've loaned to a bare trust. So come back to my original point. This is really important and really, really good question. What type of LVR are we talking about? Well, the LVR is all managed by the bank, and so they just won't lend to you anything that extends them beyond a property. If you've got 200K, you're not getting $2 million loan on a property because it's just
normally you
way
need
too
20 to 30%. You need 20 to 30%. Some banks do 20, some do 30. Depends on the place. That's basically it.
Yeah. So why I say as absolute minimum 200K is because you're going to have to pay stamp duty out of those superannuation funds. The fund has to pay for everything. It's not like you can pull open your wallet and make a contribution, because that would be considered a contribution to your fund, like an employer contribution, and you have some concessional caps on those. So we need to come up with a good cash buffer. We want you to keep 20, 25K in the fund to make sure that you are solvent over a period of time within the fund. We also need you to pay for stamps. We also need to get you to pay for legals. The fund itself will have costs. There will be council rates. There will be other things that you will need to consider over the course of your journey. That's why I say, what do you need?
25,000 in your super account to keep you safe. It's a bit like what we like to do with the offset account in real life. You want to have 25,000 offset account as well, because you need that buffer. Having a buffer is always good. So pretty smart. Dave said, is the purchase price a fraction loan? Not really. You can get properties for 600. What happens once each member comes to retirement age? Depending on each individual person ages, some might be younger, some be older. How's the income dispersed? Good question. We already explained that. The fund gets more cash and the fund can use the cash. But I think where we're matching people up, we're going to try to match horses for courses and get people in similar age brackets. We're not going to match a 21-year-old with a 65-year-old because they're not really looking at the same goal. So that's a matter of where we're matching people up. What we're looking at is, let's look at their age, how long they want to go for, looking at how much super they've got, and that's how we match people up. What's the applicable tax rate to positive cash flow each year on earnings? Well, in super, it's 15%, correct?
Yep. People are taxed 15% up to their concessional tax threshold. Anything they're making above that, they will then get Division 293, which is a nice little surprise from the government that comes and takes an additional amount from you. It's an additional 15%. And the methodology behind that is the government says, look, superannuation, we want there to be a tax incentive there for you to prepare for your retirement. But for wealthy people, and they regard that to be, once you have put in $30,000 into your super, then we're removing any further tax benefits from that.
Okay, if you already have an SMSF with a property already acquired in it, can a family member join the existing fund?
So the answer to that question is yes. I mean, there is nothing that prevents you from having multiple superannuation funds. I've spoken to people before where they've got a self-managed super fund and are interested in moving a portion of their self-managed super fund over to a 6-in super. They would still then be obligated to be directors. You can't be a member of a self-managed superannuation fund without also being a director of the corporate trustee. And then there's going to be fees in their existing super fund and fees in the other one. They might consider if they're not solvent in their other fund and they're moving all of their cash over, they might seriously consider winding down their other fund and then just having the 6-in super.
Yes.
Definitely individuals, but if the question is, can you do it? The answer to that is very much yes.
You can do it, but there's not really a point, because what we're trying to do, the overarching goal is we're trying to create more wealth by getting more property for more people. Having an existing property with more people going in it, it's already there, no point. And at the end of the day, like Jeff said, once you have a meeting with Jeff and his team, they'll have a look and make sure that all the funds are profitable and doing well before anything happens, right? Someone said, sorry, I joined a bit late. Why 6? Why not 4, 5, or 7?
The maximum allowable in a self-managed superannuation fund is regulated to be 6. That is the maximum number. You can't have 7. Can you have 4 in 6-in super? You can, but we seek the power in the numbers in order to.
6 is a really good number because it gives you enough to get a good quality property. If you got 4 in super, you could almost do 1 each anyway. That's the thing. So what we're doing is helping people that can't get it themselves. I would much rather someone get their own property than super 6 because it's going to be more powerful for you. However, if you can't get one in yourself or you got extra cash, join it with someone else and get the extra one anyway. Because the name of the game is you want to get as many properties as you can early on, and then you do nothing and wait and let them grow. Regarding interest rate, the fund is P&I and not interest only.
In superannuation, you aren't able to get a loan. Like the LRBA is the only lending instrument that you can get. That is principal and interest. You won't be able to get a loan which is interest only.
Kim said, is there a risk of one party borrowing against the super trust? I've heard horror stories that effectively allow the debt to be transferred back to the trust and the bad party member walk away with money.
Look, if that has occurred, there are some very serious
directors,
criminal. I mean, it's stealing is what it is, and you are open. Can that happen? Or I suppose it could be possible, but I mean, I could have someone come into my house and take my keys and take my car, but is it possible? Yes, it's possible, but they would be breaching some very, very significant trust law. Every trust of a superannuation fund needs to be audited every single year, and they would be very quickly found out if something has gone astray.
Okay, with Super 6, what if there is a difference between members on the borrower? How do we then determine which borrower to use?
I would say to that question, I get asked a lot of these types of questions. Well, what if this and what if this? Look, you guys all have coaches. Those coaches refer you to people. The reason why you have coaches is because they have been through all of these experiences before and have found the best ones for you. I mean, so if we had 6 people from Positive Property who are saying, oh, I don't know about that lender and I don't know about this lender, probably someone as astute as Charmaine would hit you over the back of the head and say, hey, listen, shut up. We've been doing this for a very long time and we're very good at it. And why don't we just let the train sort of move forward? I would just say rely on your coaches.
Yep. Okay, so look, One last thing, we're about to close the big group, and we're going back to a small group, our members only. If you want to check this out, type in #super. My team will reach out to you and see if we can help you. Thank you everyone for watching. It's been great. We're going to go in our private group now and go a little bit deeper.